Getting your first credit card should be a lesson in financial responsibility. Instead, for these people, it became a masterclass in how to destroy your financial future in record time. They treated plastic like magic money and discovered that credit card companies are very good at math, even when their customers aren't. Witness the spectacular financial self-destruction that happens when unlimited spending power meets zero financial literacy. 1. The $500 limit became $5,000 in Tyler's mind the moment his card arrived, leading him to attempt purchasing a motorcycle on day 1. His financial planning consisted of assuming the credit card company had made a typo on his limit and that his obvious creditworthiness entitled him to premium borrowing power. Tyler spent 3 hours at the dealership explaining to increasingly confused salespeople why his repeatedly declined card should definitely work for a $4,800 purchase, insisting they try running it one more time, because banks sometimes needed multiple attempts to process large transactions for valued customers like himself. 2. Credit cards are basically free money until you get a job, explained Sarah to her concerned parents, while maxing out her $1,000 limit on decorative throw pillows and scented candles. Her economic theory included beliefs that interest charges were optional fees for people who wanted to pay early, and that minimum payments were suggestions rather than requirements. Sarah's financial strategy involved treating her credit card like a savings account that dispensed money instead of storing it, and she remained convinced that employment would somehow magically erase any debt she accumulated during her investment period. 3. The cash advance button looked like a magic money dispenser to Marcus, who withdrew his entire credit limit in cash to have spending money, without understanding that cash advances came with immediate interest charges and fees that made payday loans look reasonable. His ATM marathon involved visiting 12 different machines to extract maximum cash, paying $3 to $5 fees at each location, while accumulating 29% APR interest that started accruing immediately rather than after a grace period. 4. I'm building credit by using it as much as possible, declared financial genius Rebecca, while purchasing her 15th pair of shoes that month, apparently believing that frequent usage rather than responsible payment history determined credit scores. Her credit-building strategy involved maxing out her card monthly and making minimum payments because keeping a balance shows the bank you actually need credit. Rebecca's credit improvement plan consistently maintained 100% utilization while she waited for her score to improve from what she assumed was underuse of available credit. 5 emergency purchases included a hot tub, vacation to Hawaii, and entire new wardrobe for Kevin, whose definition of emergency expanded dramatically once he realized credit cards worked for non-emergency items too. His crisis management approach involved treating any desire for something as an urgent financial situation that required immediate credit card intervention, regardless of whether the item was necessary, affordable, or even particularly wanted after the initial impulse passed. 6. The rewards program became Jennifer's full-time job, as she attempted to earn enough points for a free vacation by purchasing everything possible with her credit card, including rent, utilities, and groceries that she charged, then immediately paid with money she didn't actually have. Her points accumulation strategy involved cycling money between checking accounts, savings accounts, and credit cards in elaborate schemes that earned her 1.5% in rewards while costing her 23% in interest charges and overdraft fees. 7. I'll pay it off when I'm rich served as Dave's comprehensive debt management plan, while charging $50 dinner dates and concert tickets that cost more than his weekly paycheck. His future wealth assumption included beliefs that his eventual success would make current debt irrelevant, and that rich people didn't worry about money they'd borrowed when they were poor. Dave's financial timeline projected achieving wealth sometime before his first statement arrived, making current spending decisions consequences for his future successful self to handle. 8. 3 credit cards applied for and received on the same day seemed like diversification to Amanda, who believed multiple cards provided financial security through access to various credit sources for different types of purchases. Her credit portfolio management involved using different cards for different categories of spending, unaware that multiple hard inquiries and new accounts were devastating her credit score, while creating multiple monthly payments she couldn't afford to make simultaneously. 9. The business expense strategy emerged when college student Jake decided textbook purchases were legitimate business investments in his education that qualified for credit card financing, regardless of his complete lack of business income, business plan, or understanding of business tax deductions. His educational enterprise involved treating student status as entrepreneur status and credit card debt as startup capital that would generate returns through his future earning potential after graduation. 10. My parents will help if I get in trouble served as Lindsay's risk management strategy while charging spring break trips and designer clothing, apparently unaware that credit card debt legally belonged to the cardholder rather than their family members. Her parental backup plan included assumptions that financial emergencies would trigger family assistance and that her spending choices wouldn't affect her parents' willingness or ability to provide credit card debt relief for purchases they'd never approved or benefited from. 11. Cash advance financing reached new levels of creativity when Eric used credit card cash advances to make minimum payments on other credit cards, creating a debt circulation system that generated fees and interest charges faster than he could obtain new credit to maintain the cycle. His payment strategy involved moving money between cards through cash advances, balance transfers, and convenience checks, paying transaction fees at every step while never actually reducing his total debt load. 12. The investment portfolio consisted entirely of lottery tickets and scratch-offs that gambling entrepreneur Michelle purchased with her credit card, convinced that her mathematical analysis of lottery patterns would generate returns sufficient to pay off her debt, plus interest before her payment due date. Her investment strategy included theories about hot numbers, lucky stores, and timing systems that she'd researched online, while her actual investment performance consisted of losing 100% of her credit card advances on mathematically guaranteed negative return games. 13. Balance transfers are like getting new credit cards for free, explained financial strategist Robert, while moving debt between multiple cards to avoid making actual payments, treating promotional 0% APR periods like permanent interest rate reductions rather than temporary payment delays. His balance transfer arbitrage system involved opening new cards specifically for promotional rates, moving debt in circles between accounts, and paying balance transfer fees that often exceeded the interest savings he thought he was achieving. 14. Pet financing reached unprecedented levels when animal lover Carol charged veterinary procedures, grooming services, and premium pet food for 3 dogs, 2 cats, and a parrot, treating pet care as an emergency expense category that justified unlimited credit card spending, regardless of her ability to pay for either pets or payments. Her animal care investment strategy included believing that pet love justified any financial sacrifice and that responsible pet ownership required premium services regardless of affordability. 15. The credit limit increase request arrived monthly from ambitious Angela, who interpreted credit line increases as salary raises rather than opportunities to accumulate more debt she couldn't afford to repay. Her credit expansion strategy involved requesting limit increases as soon as she maxed out current limits, treating available credit as proof of her improved financial status rather than increased opportunity for financial self-destruction. 16. I'm young, so I have time to pay it off, served as retirement planning for procrastinator Paul, whose long-term financial strategy involved assuming that age automatically generated increased earning power, and that future versions of himself would have different spending priorities and superior debt management skills. His temporal wealth theory included beliefs that older people naturally became more financially responsible, and that current debt would become easier to handle as he matured into someone who understood money better. 17. Gift financing transformed holidays into credit card catastrophes when generous Grace charged elaborate presents for family and friends, treating seasonal giving as investment in relationships that would generate emotional returns worth the financial costs. Her gift budget strategy involved believing that memorable presents created lasting happiness that justified temporary debt. and that people would remember her generosity longer than she would remember making credit card payments. 18. The minimum payment looked like a maximum payment to mathematically challenged Mark, who paid exactly the minimum amount each month while continuing to charge purchases, never understanding that minimum payments barely covered interest charges and that his balance would grow indefinitely under his current payment strategy. His debt reduction plan involved paying exactly what the credit card company requested while adding new charges monthly, creating a payment system designed to maximize bank profits rather than reduce debt. 19. Credit cards don't affect your credit if you pay them, declared misinformed Melissa while maintaining maximum balances and making sporadic payments. Unaware that credit utilization, payment history, and account management all affected credit scores regardless of whether balances were eventually paid. Her credit score strategy involved believing that good intentions about future payments protected her from current credit damage, and that credit reporting agencies gave partial credit for planning to pay debt someday. 20. Emergency fund replacement came when Practical Peter decided credit cards provided better emergency access than savings accounts, because available credit didn't require advanced planning or cash accumulation. His emergency preparedness strategy involved treating credit limits as emergency funds that were immediately accessible for unexpected expenses, without considering that credit card emergencies created monthly payment emergencies that required ongoing cash flow to resolve. 21. The shopping addiction funding system emerged when retail therapy patient Sandra used credit cards to finance mood improvement through purchasing, treating spending as self-care that improved mental health enough to justify the financial stress of accumulating debt. Her therapeutic shopping strategy involved believing that immediate happiness from purchases outweighed future payment stress, and that retail therapy was more affordable than actual therapy because it produced tangible goods along with emotional benefits. 22. I'll budget after I get everything I need, explained backwards planner Tom, while charging furniture, electronics, and home decor, without calculating total costs or monthly payment requirements. His financial organization strategy involved believing that budgeting was easier after spending decisions were finalized, and that purchase commitments would motivate better money management through necessity rather than planning. 23. Credit card roulette became group entertainment when social gambler Lisa volunteered to pay restaurant bills for large groups, collecting cash from friends and charging meals to earn rewards points, except the cash collecting system failed more often than it succeeded, leaving her with bills for other people's meals and optimistic promises about future repayment. Her social financing strategy involved believing that friends would reliably reimburse credit card expenses and that reward points earned from group spending would offset the risk of covering other people's dining costs. 24. The business startup capital came entirely from credit cards when entrepreneur wannabe Carlos decided that business investment didn't require actual money, and that credit card debt counted as startup funding for ventures that existed mainly in his imagination. His business development strategy involved charging equipment, supplies, and services for companies that had no customers, no revenue, and no business plan beyond using credit to create the appearance of legitimate business operations. 25. Interest rates are negotiable if you're a good customer, believed optimistic negotiator Diana, while accumulating maximum debt at full interest rates, convinced that credit card companies would reward customer loyalty with rate reductions rather than profit maximization through high-interest debt maintenance. Her customer relationship strategy involved believing that banks viewed indebted customers as valued partners rather than profit sources, and that payment struggles would trigger assistance rather than collection efforts. 26. Fashion investment theory drove style-conscious Frank to charge designer clothing and accessories as investment pieces that would retain value while providing personal satisfaction, treating credit card debt as asset financing, rather than consumption spending that generated ongoing costs without corresponding value retention. His wardrobe portfolio strategy involved believing that expensive clothing functioned like financial investments that would appreciate over time rather than depreciating consumer goods that lost value immediately after purchase. 27. The convenience fee acceptance reached new heights when efficiency expert Helen charged small purchases at gas stations, coffee shops, and convenience stores to avoid cash transactions, paying processing fees and interest charges that often exceeded the cost of items she was purchasing. Her payment optimization strategy involved treating credit card convenience as worth unlimited costs and believing that cashless transactions saved time even when they cost more money than cash payments. 28. Credit cards teach you about money served as educational justification for learning through experience student Ian, who treated debt accumulation as financial literacy training that would provide practical knowledge about money management through direct experience with consequences. His experiential learning strategy involved believing that credit card mistakes were valuable education worth paying for, and that financial knowledge gained through debt accumulation would justify the cost of learning about money the expensive way. 29. Travel financing reached peak irrationality when wanderlust victim Jenna charged vacations to create memories that last forever, treating travel debt as investment in life experiences that provided value beyond monetary costs. Her memory portfolio strategy involved believing that travel experiences justified unlimited spending because memories couldn't be repossessed, and that life experiences were worth more than financial security or debt freedom. 30. The rewards point maximization system became more expensive than paying cash when Points Optimizer Kevin charged everything possible to earn rewards, paying annual fees, interest charges, and transaction costs that exceeded the value of points earned through his spending optimization strategy. His rewards mathematics involved complex calculations about point values, while ignoring the simple math showing that his reward pursuit cost more money than the rewards were worth. 31. Rich people use credit cards for everything, served as lifestyle modeling for aspiration-driven Laura, who imitated wealthy spending patterns without wealthy income levels, treating credit card usage as demonstration of financial sophistication rather than indication of cash flow insufficiency. Her wealth emulation strategy involved believing that spending like rich people would eventually result in becoming rich, rather than becoming poor through unsustainable spending patterns. 32. Home improvement financing transformed rental apartments into credit card renovation projects when decorator Martin charged paint, furniture, and fixtures for properties he didn't own, treating temporary housing as investment opportunities worthy of credit card debt accumulation. His rental investment strategy involved believing that apartment improvements would enhance his living experience enough to justify debt payments that would continue long after moving to different housing. 33. The relationship investment theory emerged when romantic Nathan charged expensive dates, gifts, and experiences to impress partners, treating credit card debt as relationship-building investment that would generate long-term emotional returns worth short-term financial costs. His dating portfolio strategy involved believing that memorable romantic experiences would strengthen relationships enough to justify debt accumulation, and that love conquered financial stress rather than being destroyed by it. 34. You have to spend money to make money, justified entrepreneurial thinking for multi-level marketing participant Olivia, who charged inventory, training materials, and conference attendance fees for business opportunities that required upfront investment but generated minimal actual income. Her business investment strategy involved treating credit card debt as necessary startup costs for ventures that promised financial freedom through product sales to friends and family members who didn't want to buy anything. 35. Technology financing reached absurd levels when gadget enthusiast Patrick charged every new electronic device release to stay current with technological advances, treating credit card debt as investment in staying relevant rather than unnecessary spending on devices that would become obsolete before credit card balances could be repaid. His technology portfolio strategy involved believing that current devices were essential for future success and that technological relevance justified unlimited credit card spending. 36. The social status maintenance system required credit card financing when image-conscious Quinn charged clothing, accessories, and lifestyle items to maintain appearances among financially successful peer groups, treating debt accumulation as necessary investment in social positioning and professional networking opportunities. Her reputation management strategy involved believing that successful appearance would generate opportunities worth more than credit card debt costs and that social connections required financial investment regardless of actual affordability. 37. Credit cards are safer than cash. Served as security justification for risk-averse Rachel, who charged everything possible to avoid carrying cash while accumulating debt that created financial risks far greater than potential cash theft or loss. Her security optimization strategy involved believing that credit card protection against fraud justified unlimited spending, and that financial security came from avoiding cash rather than avoiding debt accumulation. 38. Pet emergency preparedness involved credit card veterinary financing. When animal lover Steve decided that responsible pet ownership required available credit for potential medical expenses, treating credit limits as pet emergency funds rather than debt opportunities that would create ongoing payment obligations regardless of pet health outcomes. His pet care strategy involved believing that credit access demonstrated responsible animal ownership and that pet love justified any financial sacrifice, including debt accumulation for hypothetical emergencies. 39. The investment education program consisted entirely of financial books, courses, and seminars that teacher wannabe Teresa charged to credit cards, treating financial education costs as investment in future earning power rather than current spending that increased debt without generating immediate income. Her educational investment strategy involved believing that financial knowledge would eventually justify educational costs and that learning about money management was worth going into debt to afford. 40. I'm building business credit, explained confused contractor Victor, while using personal credit cards for business expenses and ventures that generated minimal revenue but maximum debt accumulation, treating personal credit as business financing, without understanding the legal and financial distinctions between personal and business debt obligations. His business development strategy involved believing that business expenses on personal credit cards would improve business credit scores and that business losses could be offset by personal credit access. 41. Holiday tradition financing transformed seasonal celebrations into year-round credit card payments. When Festive William charged decorations, parties, and gifts for every holiday throughout the year, treating seasonal spending as investment in family traditions rather than unnecessary expenses that created ongoing financial obligations. His celebration investment strategy involved believing that memorable holidays justified unlimited spending and that family traditions were worth more than financial security or debt freedom. 42. The expert consultation fees accumulated when DIY enthusiast Yvonne charged professional services for projects she couldn't complete herself, treating credit card debt as education investment rather than expensive acknowledgement that her DIY capabilities were insufficient for projects she'd attempted. Her learning investment strategy involved believing that professional help would teach her skills worth more than consulting costs, and that DIY project failures were valuable education worth paying professionals to fix. 43. Credit cards help with cash flow, served as business justification for cash-strapped Zach, who used credit cards to bridge gaps between income and expenses without understanding that credit card payments would increase future cash flow problems rather than solving current financial shortfalls. His cash flow management strategy involved treating credit access as income supplement and believing that future cash flow would naturally improve enough to handle both current expenses and additional credit card payment obligations. 44. Subscription service financing reached peak absurdity when convenience lover Alice charged monthly subscriptions for streaming services, meal deliveries, beauty products, and subscription boxes that individually seemed affordable but collectively exceeded her monthly income when combined with credit card minimum payments. Her subscription portfolio strategy involved believing that monthly convenience was worth ongoing credit card debt, and that multiple small purchases were more manageable than single large purchases, despite creating permanent monthly payment obligations. 45. And finally, there's Brandon, who decided that having a credit card meant he was ready to become a real estate investor and charge down payments, inspection fees, and closing costs for multiple property purchases, using cash advances and convenience checks from every credit card he could obtain. His real estate empire building strategy involved using credit card debt as investment capital for properties he couldn't afford. Creating a financial house of cards where property investments depended on credit card payments which depended on rental income from properties that needed credit card financing for maintenance and repairs. Brandon's property portfolio required constant credit card cash advances to maintain mortgage payments, property taxes, and repair costs, while generating rental income that was insufficient to cover either property expenses or credit card payments. His real estate investment career peaked when he owned 4 properties, owed $47,000 in credit card debt, and discovered that property ownership involved ongoing expenses that exceeded rental income by amounts that required additional credit card financing to maintain. His investment strategy collapsed when credit card companies stopped increasing his limits, and properties required repairs that exceeded his available credit, leaving him with multiple mortgages, maximum credit card debt, and rental income that covered approximately half of his monthly payment obligations. Brandon's entrepreneurial real estate adventure ended with bankruptcy proceedings that included 4 property foreclosures and credit card debt that exceeded the total value of his real estate investments, proving that creative financing was often just expensive procrastination that postponed financial reality rather than avoiding it. Here's the truth about credit cards. They're powerful financial tools that can build wealth or destroy futures, depending on whether users understand the difference between building credit and building debt. These people discovered that plastic doesn't make purchases free. It just delays the payment while adding interest charges that make everything more expensive. The most expensive education you can get is learning about compound interest from the wrong side of the equation. Want to use credit cards responsibly? Treat them like debit cards that send you a bill later. Want to destroy your financial future? Just follow these examples. Subscribe if you prefer learning about money mistakes from other people rather than your own credit card statements.